Good morning. I'm Marc Ostwald. I'm Chief Economist and Global Strategist at ADMISI in London. We have come to the end of another month, and the themes for the new month will be the same as they have been for much of the year, i.e. we keep on looking at the same old thing, which is trade and President Trump's desire to disrupt things on the trade front and improve things. But let's talk a little bit on that front about China. I think we've had the NBS PMIs today. They were slightly better for choice than people had been expecting. But in broad terms, if one looks at it, really all the PMIs have been telling us for a very, very long time is painting a picture of very steady growth. Nevertheless, the composition of that growth has been changing, and it's very noticeable at the moment that you are starting to see a bit of a pickup in consumer spending, and you're also seeing a pickup in infrastructure spending after our hiatus at the beginning of the year. That's probably what gave the white line on there, the manufacturing PMI, a bit of an improvement. It matters not really how the Chinese economy is actually doing in performance terms, but rather how people perceive it in the context of the trade tensions with the USA. So obviously the theme on that front has been for quite some time what has been going on with the Chinese yuan. So if we look at the next chart, this is the CFETS foreign exchange index. This is the index which the Chinese authorities target. We are starting to see a good deal of stability materializing in this. Ironically, if you look at that chart and superimposed a copper chart on top of it, you'd see that it's got exactly the same trend, which is actually quite sad in the sense that copper is probably one of the areas where we're not actually too worried about what's going on in terms of trade. It would obviously be impacted in terms of domestic demand, but per se, it's not an area which is under dispute. So what's been driving this? Well, a lot of it really, one has to say, is less China trying to devalue the yuan, and far more, one would have to suggest, what's been going on with Chinese interest rates. So if we look at the next two charts, the first one is the key 7-day Shanghai interbank offered rate. And that probably tells us a lot about why we've seen some more stability in the yuan of late. Having plummeted down as low as 235, the rate is now back up to 263.30, and we're starting to stabilize those interest rates there. Clearly the flow of funds now to the smaller businesses in China, to the SMEs, which the PBOC and the central authorities are trying to encourage, is starting to have some impact, and this is also helping to stabilize the yuan. If one looks at the next chart, which is the China 3-year yield, it's a very, very similar picture. But what we see here, obviously, is there has been some narrowing of the rate differential with the US. It's now starting to pick up again, and that in itself serves to stabilize. So the real question now is Mr. Trump going to impose that extra $200 billion of tariffs next week? And to what extent are we actually missing the big picture here? Because to my way of thinking, one of the big problems with the post-global financial crisis era is that everyone's been trying to get a bigger slice of the global trade pie. And yet if we look at the economies which have done well over the past 10 years, particularly China and indeed the USA, a lot of it has been driven by domestic demand. So the question would be, how should we balance this picture out? Clearly, if we do see a drop in overall global trade volumes, it will have an impact on China and above all on the EU, which is even more dependent on trade. But then we look at the other side of the coin, because it's not just about China in terms of trade tensions. It's also about NAFTA, and it's also about trade tensions with the EU, which I'll deal with in another segment on another day. But let's have a look at Canada. Interestingly, on this front, the Canadian dollar really isn't getting much benefit from the fact that it is basically, we've got a scenario now where the Bank of Canada is trying to keep up effectively with the US in terms of rate hiking. We've got supposedly, today is obviously the big crux day, a deal nearing on a revised North American Free Trade Agreement, NAFTA. Oil prices are going up, and yet the Canadian dollar doesn't really seem to be getting much benefit from it. So the question really would be, what happens next in terms of what goes on? Some of the stumbling blocks which have been mentioned in terms of a NAFTA deal include dairy, which is actually quite peculiar, because actually in the original Trans-Pacific trade agreement, Canada agreed straight away to drop all its trade tariffs on dairy products, and in terms of overall volumes of trade, we're talking about something which is no more than $1 billion in terms of a bilateral trade between the US and Canada. So at the end of the day, really what this boils down to is trade is still going to be the theme for the coming months, but we are at a point where I think where everything becomes that much more critical in terms of we are reaching deadlines, be it NAFTA, be it China, be it the EU, where things will start to crystallize in one direction or another. Either we'll see the whole trade wars as something of a storm in a teacup, or we go into a situation where trade tensions start to dampen global growth. Jury is still out on which side we're going to come down on.